Back in 2020, we saw everything really crash. That was from January to like April of 2020. The stock market, gold, silver, the CRB index, bonds, of course, were very volatile. They were up and down like a yo-yo, which isn't good either, because treasuries specifically are supposed to be as good, well, not as good as gold, but they're supposed to be very stable and risk-free, and they were anything but. And it's one of the reasons why Jay Powell had to start QE to stabilize the treasury market. But one thing that happened is that gold dropped from 1750 to 1450. It was very quick, and then it took off. And by by July or by the summer of 2020, the same year, gold was back towards 2000, while commodities lagged. And commodities only topped in June of 2022. So gold and silver, to some extent, led the way, and then commodities followed. But for the last 2.5 years or so, commodities have been consolidating in this pennant formation. As you can see here, this is the CRB index. It's a Commodities Research Bureau index. It's a collection of major commodities. It includes gold and silver as well. And I've been talking about this for the last few months, that it looked like we're going to break out of this consolidation. And usually these consolidations after a major leg up, they can either be, well, they can be 75% of the time very bullish, or 3 out of 4. Sometimes they fail and the market goes back down. And I think it's definitely breaking out here. And it's a little bit delayed, of course, compared to gold. Gold started breaking out, I think, February last year. We broke through that 2100 barrier in gold, and here we are almost at 3000. So I think it's going to take a little longer here for the CRB to actually break the June 22 high, which was 330 or thereabouts. But I think we're going to have a major leg up, and I think we're just beginning this secular bull market in commodities. It's going to be protracted. It's secular. And I think what it means, along with gold and silver moving higher, is that our currencies, our fiat currencies, are actually, they're beginning to show what they're really worth after years of central banking inflation. And by inflation, I mean all the money printing and also the fiscal loose fiscal policy of the major countries. We're up to here in public debt. This is how the system rebalances itself. I think we are in the age of hard assets and tangible goods, commodities. It doesn't mean to say that stocks and bonds are going to disappear, but they're just going to underperform massively.
Back in 2020, we witnessed a global financial tremor that rattled every corner of the markets. From January to April, it was sheer chaos. Stocks plunged, gold fell sharply from 1,750 to 1,450. In what felt like a blink, silver tumbled. The CRB index, which is a basket of key commodities, dropped hard, and even treasuries, those supposedly risk-free assets, wobbled like a spinning top on its last few revolutions. Treasuries are supposed to be as good as gold. Well, not quite, but they're supposed to be boring and stable. But in 2020, they weren't. And it's precisely that instability in what we call safe assets that led the Fed to jump in with both feet and begin another aggressive round of quantitative easing. QE. They had to. The Treasury market was cracking. But here's the thing. While gold briefly dipped during the panic, it came roaring back. By July of 2020, just a few short months later, gold had climbed back near the $2,000 level. It wasn't just a recovery, it was a statement, a shot across the bow of the fiat monetary system. Meanwhile, commodities as a group lagged. They didn't peak until June of 2022, almost 2 years later. This sequencing is critical, and many people missed it. Gold and silver often lead. They act like the bloodhounds of the monetary system. When something is off, when inflation is creeping, when trust is eroding, gold smells it first. Silver's not far behind. Commodities like energy and agriculture, they follow. They reflect the lagging effects of money printing and policy errors, but gold and silver, they anticipate. Now fast forward to today, and we're watching what looks like the beginning of a breakout. I've been discussing this for months now, this tight triangular consolidation in the CRB index. Picture a spring being coiled tighter and tighter. That's what's been happening for the last 2.5 years, and now it's starting to uncoil. It's not a guarantee, it never is, but statistically, when you get a technical setup like this after a massive move higher, you get continuation 75% of the time, 3 out of 4 times. That's not speculation. That's pattern recognition. That's history. And look at gold. We broke the $2,100 level in February last year. That was resistance for years. Now we're flirting with $3,000. That's not just a technical breakout. That's a macro revaluation. It's the market telling us, hey, your currencies are losing credibility. The CRB index hasn't yet broken its 2022 high of 330, but I think it's coming. I think we're going to surpass it and leave it in the dust. We're entering a secular bull market in commodities. Not a short-term trade, not a flash in the pan, a long, drawn-out structural bull market, one that could last a decade or more. What's driving it? Years, decades really, of loose central bank policy. They've been printing money like it's monopoly cash. And politicians, well, they've been spending like it too. The combination of central bank inflation and fiscal irresponsibility has brought us to the edge. Now the reckoning is unfolding. Our currencies are starting to reflect their true value. And it's not a pretty picture. We've entered the age of hard assets, tangible things, things you can hold, touch, stack, real wealth, gold, silver, copper, oil, food. Commodities are no longer the unloved stepchildren of Wall Street. They're the antidote to the sickness of fiat. Now, to be clear, I'm not saying stocks and bonds will disappear, but they will underperform massively. There will be nowhere to hide in paper assets when the revaluation of real assets is underway. It's not that stocks will all crash overnight, though some will. It's that they will fail to keep pace. They'll fall behind. That's what happened in the 1970s, and I believe we're in a similar cycle now. We could call it the Great Rotation, out of financial assets and into real ones. Look, gold already gave us the signal last year. It's been leading. It's telling us what's coming, and now commodities are following. Silver, as usual, is the sprinter in the back waiting for the gun. When it runs fast and far. And this time, I think it's going to break $50 like a knife through butter. After that, $100 is not only possible, it's probable. And that's just the beginning.
Gold started breaking out, I think, February last year. We broke through that 2100 barrier in gold, and here we are almost at 3,000. I think it's going to take a little longer here for the CRB to actually break June 22 high, which was 330 or thereabouts, but I think we're going to have a major leg up, and I think we're just beginning this secular bull market in commodities. This is not going to be, it's going to be protracted, it's secular, and I think what it means, along with gold and silver moving higher, is that our currencies, our fiat currencies, are actually, they're beginning to show what they're really worth after years of central banking inflation. There's been such a huge bubble created in the paper market, in the 60-40 stocks and bonds, that even a small percentage of the money flowing to commodities is going to make it a huge, relatively speaking, outperforming market to stocks and bonds. And I told you in the beginning that I'd tell you what this means, this breakout in commodities, and that I'm going to refer to a pocketbook of gold by Jim Sinclair. He wrote it along with someone called Peter Carlin. And unfortunately, Jim Sinclair passed away, I think it was last year. And Jim Sinclair, I started following him in 2002 when I started buying gold and looking into gold. He had a great blog called JS Mindset, so I have a lot to thank Jim Sinclair for. And it's a shame he's not here to see this bull market in gold. But he did see the one in the 70s though. Anyway, I want to talk about gold is a revealer of falsely stated wealth. It's on page 70, as you can see here. And it's tough to get this book, unfortunately. Someone asked me if I could copy it and put it in a PDF file, but that's not something that I do. This is copyright. You're just gonna have to search for it, and it's not gonna be cheap, unfortunately. So let's see what gold really tells us, and commodities as well for that matter. When wealth is overstated and expectations for future wealth are unrealistic, fiat currencies depreciate. Well, that's what we're seeing now. I think the jig is up for the falsely stated wealth camp. The depreciation is borne by the citizenry who are forced to lower their living standards to compensate for both personal economic mismanagement, well, taking on too much debt, not stacking enough, as well as the mismanagement of the affairs of states. Well, they're trying to fix that, but I think it's a little bit too late.
Gold and silver remain the ultimate safe havens in times of financial uncertainty, and their historical role as protectors of wealth cannot be overstated. As fiat currencies continue to face pressure from inflation and debt-driven policies, hard assets like precious metals offer tangible value and long-term security. The cyclical nature of markets, especially when manipulated by ultra-loose monetary policy, always comes full circle. This is what we're witnessing now, a reawakening to real value. Commodities as a whole are breaking out. The CRB index is leading the charge, but gold was the tip of the spear. It showed the way, and now silver is catching up, behaving like the loyal hunting dog that tracks behind but always finds its prey. When you look back at 2020, during the COVID crash, gold was the first to bounce and even made new highs that year. That told us everything we needed to know. The realignment of financial markets had already begun. Since then, while central banks in the West played games with interest rates and stimulus, central banks in the East, China, India, Russia, were quietly accumulating gold. And what are they doing now? Repatriating, removing their gold from London vaults, from New York, and taking delivery into their own sovereign-controlled vaults. These are not just symbolic moves. These are declarations of independence from the dollar-centric system. It's a statement. We no longer trust the custodians of yesterday's monetary order. And who can blame them? With debts mounting and the political climate in the West increasingly chaotic, who in their right mind would trust the long-term purchasing power of a fiat currency like the dollar or euro? Yet here we are in 2025, and most people in the West still believe in the illusion of infinite credit, the illusion that governments can endlessly print money and manipulate interest rates without consequences. But gold doesn't lie. Gold reveals. It reveals the truth about the erosion of purchasing power, about fiscal irresponsibility, and about the widening gap between real and false wealth. As Jim Sinclair once said, and I quoted earlier, gold is the revealer of falsely stated wealth. We see this more than ever as traditional assets become dangerously overvalued. The S&P 500 may be making nominal all-time highs, but priced in gold, it's still down significantly from its peak. That tells you all you need to know. This isn't a genuine bull market. It's an inflationary illusion. We're in the early stages of what I believe will be a decade-long secular bull market in commodities. Unlike the last 10 to 15 years, where financialization and cheap credit ruled, we're moving into an era where physical assets, things you can hold, mine, grow, or build, are becoming the new store of value. It's a back-to-basics shift, and gold and silver are at the core. Now, why has silver been lagging? As I mentioned before, silver has always been more volatile. It climbs higher and crashes harder. But that's precisely why, in a commodity supercycle, it often outperforms gold. Silver's industrial use, from solar panels to electric vehicles to electronics, is growing rapidly. Combine that with its historical monetary role, and you have a coiled spring. If silver catches up to its historical gold ratio, say 40 to 1 or even 30 to 1, that alone would mean silver prices north of $90 or $100 if gold hits $3,000. But I believe we'll surpass those targets. And once the public starts piling into silver, like they did in 2010 to 2011, it could easily double again. What's different this time is the structural deficit in physical silver. Mints are reporting months-long back orders. Refineries are under pressure. You can't fake physical demand. This is real. And as for the miners, well, they're still the best-kept secret. The gold stocks, especially the mid-tier and junior producers, are trading at absurdly low valuations. PE ratios of 7 or 8, balance sheets with more cash than debt, and with gold prices up 30%, 40%, or more over the last 12 months, their margins are exploding. Yet Wall Street is still asleep, but not for long. As the general market begins to stumble, whether it's from the bubble in tech, or another wave of inflation, or geopolitical instability, capital will flow into real assets. Wall Street doesn't care about ideology, it follows performance. And once it sees that gold and silver are outperforming, the floodgates will open. It will be like 1979 all over again. Back then, everyone laughed at gold bugs, until they weren't laughing anymore. Until gold ran from $200 to $850 in under a year. Until silver shot to $50. And that was in a much smaller, much less interconnected world. Today, the mechanics are faster, the leverage is greater, and the trust in institutions is far lower. The moment of realization will come, and when it does, you won't want to be scrambling to buy ounces at $5,000 gold and $200 silver. You want to be positioned before the herd wakes up. That's the contrarian advantage. Now let's talk about the elephant in the room, currency devaluation. Donald Trump has made no secret of wanting a weaker dollar. He sees it as a way to boost exports and rein in the debt. And Scott Bessent, the new Treasury Secretary, is openly talking about monetizing the asset side of the balance sheet. That's code for gold revaluation. Pegging a new system, possibly even using blockchain-based treasury instruments backed by gold. It's a digital gold standard in everything but name. And if they do revalue gold, say to $10,000 or even $25,000 an ounce, what happens to everything else? What happens to silver? What happens to gold miners? What happens to the dollar? The implications are enormous. You might be asking, well, isn't this a bit conspiratorial? Look, the central banks have already told you. Gold was reclassified as a Tier 1 asset by the BIS. The Swiss and German central banks are actively increasing reserves. China is buying gold every single month. Russia too. Even Poland. They know what's coming. This isn't speculation, it's preparation. So to my viewers, my readers, my fellow stackers, be early. Don't be right at the wrong time. Accumulate gold. Accumulate silver. Look at undervalued miners. Educate yourself. Disconnect from the noise and focus on the fundamentals. The signals are all around us. The financial system is changing. A storm is coming. And gold and silver are the lighthouse in that storm.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.